The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Well, as we came out of the holiday weekend and started the month of September, we found a corn market that had a little bit of support to start the week, maybe trying to continue some of the goodwill from the end of August in the corn side of things, while soybeans were down double digits to start the month. Wheat was mostly lower as well, and we had a mixed day over in the cattle complex. Let's talk about things and get some perspective on these markets. Joining us now, Brian Splitt with agmarket.net. Brian, good to talk with you, sir. Hope you had a good holiday weekend, and good to have you back with us on the show.
Yeah, likewise, Jesse. Always good to be here, and sounded like you had a pretty solid birthday weekend yourself.
Yeah, a little bit of travel. Had the Farm Progress show last week, and then some family time in the St. Louis area before heading back to Nashville. So it definitely feels good to be home. And, you know, I couldn't believe that we've already turned the calendar to September, Brian. That to me, just it seems like time continues to just roll on by really, really fast the older that I get. And we're almost to the finish line with this harvest season. I mean, we're going to be ramping things up over the next several weeks in the bulk of the Corn Belt. And, you know, here's a corn market that's holding up pretty well here at the end of August and through the holiday weekend. Soybeans, a different story. Maybe we should start there. Just looking at soybeans, was it profit taking Tuesday? I mean, what's your thoughts in that soy complex overall, Brian?
Yeah, I think the soybean market found itself going into a holiday weekend really at the upper end of a range that it's been in for quite some time. And when you think about July soybeans, for example, kind of the back end, we came within 2 cents of the highs for the year on the high last week. When you look at Nov 26, we were within a nickel of the highs for the year to finish up the week. And there was some kind of chatter that maybe we were going to get some type of trade news over the weekend. It was eerily reminiscent of going into the July 4th weekend where there's talk about, hey, we're going to get a trade deal announced. And we didn't. And then we kind of came out of the weekend soft and started a bit of a selling event. But I think there's just, considering where the soybeans are positioned, I do think we've probably priced in the idea of, hey, we don't have that 2 million acres, right? We lost that on the August report. I think the market's priced in the idea that we've probably seen the top end of the yield come off. But we have some overarching bearish things going on in beans. And number one is China just still hasn't bought beans yet. Number two, very quickly, we're going to talk about Brazil planting and what type of crop potential we have there. We saw last year 154 million ton crop. This year, 169 million ton crop. So estimates for next year are going to be probably in the mid 170s, 175 million tons or higher. And I think the market's very well aware of the dynamic or idea that we're going to go domestically shifting from a large corn number planting in 2025 to a much smaller planting number, probably closer to 91 million acres next year, and bean acres are going to go higher. So I think there's some kind of bigger picture things going on bearish beans, maybe some shorter term friendly things going on bearish beans. But to me, just when I look at the chart and simplify it, we were at the upper end of the range, and we may just want to go back down to the low end of the range again here if we can't get other bullish things to talk about.
Well, and a couple things I want to ask you about with soybeans as well. I heard you talking with our good friend Tommy Grisafi last week on the Cow Guy Close on RFD TV. He was filling in there, and you guys were discussing some of the cash basis issues in, say, the Dakotas, for instance. And a lot of that stems back to China. They're not buying most of those markets in the upper Midwest and Northern Plains for soybeans. It's all geared to travel to the PNW. And so I know when you look at soybeans from a cash perspective right now, depending on your location, there's a lot of folks who are very concerned because they don't have many options when it comes to the cash side of things right now, Brian.
Right. And so regardless of what the board does day to day, basis for most is pretty horrendous, and obviously worse for some than others. There are some bright spots out there, and I think the further east you travel, maybe the more stronger basis opportunities lie there in the short term. But it just seems like we're in a situation right now where there's kind of a priority of figuring out, hey, the bushels that need to be sold out of the field that I can't store for soybeans, I have to be coming up with a plan for that, at least on the future side of it. I don't know that there's going to be much basis appreciation in between now and harvest unless we do get some type of Chinese business to come in. But I think there will be basis appreciation down the road, maybe as you get into December, January. So, ultimately, the bushels that you have the ability to store, I think the goal there is to take advantage of the carry. When you have some of the deferred contracts, March, for example, up in the 1080 to 1090 area, if you can get into that zone, you probably need to look at that particular price level for March, and then see if you can get some basis appreciation between now and a couple months down the road. Without the PNW market, that does leave a very sizable portion of our producers rather vulnerable to very poor basis levels.
Another story that could maybe become bullish for soybeans and for the corn market too. Last several days, we're getting more chatter about low water levels on the Mississippi River again, south of St. Louis, because it's been dry in the eastern Corn Belt, for instance, and the Ohio River flowing in and things of that nature. Is that something outside of anything with China here, Brian? Do you feel like that could become a bullish story for corn and soybeans here moving forward?
Well, it's a mixed bag, because I think the water levels decreasing speaks to really what we saw over the month of August, right? And so when we relate that to the crop, especially from where the USDA had it pegged on the August WASDE report, all of that data is as of late July, right? So these satellite imagery that they use for yield estimates, that's as of late July. And so here we are early September. And so the decline in water level speaks to the bigger picture issue, which is the Eastern Corn Belt had a very dry August. So that to me gives me something, says underlying, yeah, we probably saw the top end of the yield come off based on what the water levels are doing, but that presents its own logistical challenges. And that's something that we've talked about in previous years when you get really low water levels and you can't move the same amount of product, right? So then you start to talk about the impact of barge freight rates and all of that going on. And it just becomes more of a logistical challenge to move the product out of the Gulf. And so when you have less efficiency out of the Gulf, that could be something that hampers the export program. So I see it as, a positive to the idea of maybe the crop got smaller, just again, based on the dryness that we've seen in August, but there's going to be some challenges moving ahead here on exporting grain out of the Gulf if those water levels continue to drop.
When you look at that corn market and you mentioned maybe some top end coming off of yields with how dry things were in August, I look at corn, it's been relatively okay, I guess is the best way I could say it here, to end August, to begin September, a little bit higher, 1 to 3 higher really on Tuesday. When you look at the corn complex, you look at charts, what are your thoughts here as we start the new month?
So number one, I would say that the month of August posted what we would call a monthly hammer bottom. And then that just speaks to the shape of the candle, right? So number one, we closed near the high of the month. We closed above the opening price for the month. And the bulk of the trade for the month, or the tail, was below the open. So it's got a very long tail. We closed near the high of the month. So that's something that to me suggests that we turn the momentum of the corn market from down to now up. That doesn't mean we need to just continue to go up straight away, but this should suggest that we've turned into a buy the dip market instead of a sell the rally market with that change in monthly momentum. Number two, I would tell you that the continuous chart, if you draw an uptrend from lows that were scored during COVID, so that was back in 2020, and take that line across to the lows that were scored last year in August, maybe we jab through that line a little bit, but if you just step back and from the chart and take a 5 foot away look at it, it looks like we just went to the trend line and bounced off of it and closed near the highs of the month. So that looks very positive. So I think we've got some good big picture things that have developed in corn, especially considering the day we made the low was the August WASDE report, when we got which probably is the most bearish information that we're going to get here. And we should hopefully see the yield come down in the next several reports based on the August conditions. The caveat to that, Jesse, is the USDA behavior from last year. We had a very dry August, just the same as this year, but they still raised yield in September and October because we didn't get to the ear weight conversation yet. That didn't come until November, and that's what dropped the yield. So I think the market kind of knows that, but I think there's a lot of pressure on the USDA because of how big they raised yields in August to very quickly adjust it if they should, and I think they should. So hopefully it's not a repeat of last year, but last year the market sniffed it out and started doing its own thing regardless of what the USDA was telling us. So that's maybe a bright positive there, is that the market maybe knows ahead of time, even though the USDA may not acknowledge it. But I think one of the other elements of this too, Jesse, is that let's just say that you carry in to next year what the USDA suggests we're going to, a little over 2.1 billion bushels. If you carry that into next year and we only plant 90 or 91 million acres, and we say, hey, we're going to maybe raise yield to a trend of 181.5, if the demand structure doesn't change, we don't have any room for error on next year's crop. So considering input costs for next year and already that conversation of going back to a lower corn acreage number next year, I think there's going to be some buying interest, and has been some buying interest in D's 26. And 440 should be very, very good support for D's 26. I think that contract's got to run up to the 480 to 485 area at some point here prior to getting the March planting intention numbers done. And hopefully it's at a level that locks in insurance levels at that type of a price before we get the crop planted.
And you raise a really great point, and I'm starting to hear more of this chat or this conversation about where current price levels are at for corn and thinking about input costs for 26, seed, chemical, fertilizer, et cetera. And I've even, seen some posts on social media comparing things to, the price of corn today, cash price is the same as it was in 1974. And then you look at the cost of inputs being triple that or whatever the case is. And so I know a lot of producers are nervous. They're looking at things very, very closely. I guess that makes me think about something like D's 26 corn. I know there's opportunities out there to lock in a floor and leave the top side open. It's a matter of what works for your operation, but there are tools out there to try and manage this, right, Brian?
Yeah, in the short term here, I would consider D's 26 in an upward trending channel. The upward end of that channel is going to be in that 480 vicinity, depending on how long it takes to get there, if we can continue to see some buying. But I think that's a very real concern for the market is, maybe we need to find a price that doesn't allow acres to drop that low next year. Because again, and a lot of this depends on how the demand profile changes. And I think the bears out there will argue, all right, well, if the corn production number for this year comes down, so too will demand. And I agree to an extent. Last year when the USDA lowered yield in the January report, they dropped the demand number, pretty big cut to demand at the same time they cut production. But the thing when I look back at that is that was procedural. They only cut demand because they cut production drastically. They didn't have any reason to other than that. The pace analysis of exports suggested otherwise. And then what ended up happening? You get past the March stocks report, what does USDA start doing? They start putting export demand back in, right? Because they had to, because we kept selling it. So to me, when I think back about last year, we saw corn go from $4 to $5. We didn't ration demand at $5. We were still exporting it that whole time. The market came down because the focus shifted from old crop to new crop, right? What does the new crop balance sheet look like as we get deeper into spring? And without any weather issues, it ballooned over 2 billion. But now we're going to have the exact opposite thing happen next year, where unless we find a price that rations export demand, and again, I'm going to argue $5 corn didn't do it, we have to carry in 2 billion bushels into next year, because if our demand profile stays the same, we got to have a big record crop again just to keep the carry out from dropping into the low to mid 1 billion bushel area again next year. So I like these 26. I think the funds are going to keep chomping on that contract every time the market dips.
Any notes for you in some of these other grain and oilseed markets, whether we're talking wheat or we look over at the softs and cotton, things of that nature, before we touch on livestock? Any other notes, anything else you're paying attention to here this week, Brian?
So I think something wheat needed to get out of its system. The hard red wheat needed to make those lows going into delivery. We made new contract lows the day before first notice day. A lot of times bear markets, much like corn, we've seen that happen numerous years where we go and make a low into delivery for, the D's contract or the March or what have you. So wheat did it into the September first notice day in the hard red. The nice thing is Chicago wheat, the soft red wheat, avoided new contract lows. We made a low that was higher than the previous, and then today's low actually went right to that trend line and held again. So it seems to me like wheat's trying to build a little bit of a base of lows down here. I think wheat seasonally is going to make a low here and go up as we start getting wheat drilled in order to incentivize some extra wheat acres, because I think where prices are right now, and wheat's not a cheap crop to grow either. I don't know that anybody's real ecstatic to grow wheat. When you've got some of the moisture that we've seen out in the plains, I think you could see some of that acreage go to grazing pasture and maybe not get planted to wheat unless the price tells us otherwise. So I think wheat should see a good recovery here from these levels over the next couple of months. Cotton, we just made a move here back down kind of the low end on December cotton futures coming out of the weekend. So we're at levels that I would say really need to hold. We've held these levels going back to spring, but there's just not a bright spot for cotton right now from a demand perspective, without something happening with China. I do think there's some concerns about how the production side of things may line up here, but it might take a little bit of time to work itself through the system. We just want to keep seeing the low end of the range holding cotton and avoid making new lows. Another market that has been trading pretty wild recently is the rice market. And there's a problem with rice right now is we still have old crop and it's poor quality. And that seems to be what's really brought the rice market down into delivery of the September contract. Is just quality issues in rice. But I suspect that at some point they're going to want to buy up a lot of the new crop rice to blend with the old crop to get it up to grade. So I think you're going to start seeing some good demand for the new crop harvest to be able to allow that to happen. Metal market's another exciting market, right? You got gold and silver. I would say gold just broke out of an ascending triangle to the upside, measures probably to about $3,850 for the big picture upside objective of that breakout. And we've had silver, push through 40. And what's incredible to me is, and you think about gold, nearly double the price of highs that we had in 2011, yet silver hasn't even tested the 2011 price. And I think there's a lot of people that think silver has been artificially kind of held and manipulated to a low price. The United States government put silver on an essential mineral list here recently. That's the first time that's happened. So I think there's some excitement going on in silver that maybe this market has some very strong upside, especially after the Jackson Hole meeting here too, when we talked about monetary policy being based on the labor market more so than inflation. And that means that maybe the inflation is going to start getting ramped up here, and it's going to be less of a concern than what's going on in the labor market. So I think you've seen a lot of money coming to precious metals after that meeting.
Let's close with the protein sector and look at cattle specifically. Kind of a mixed bag on futures Tuesday, but what can you say about this cattle market? August was a wild month with plenty of upside here. September, post Labor Day, do we start to see some of that summer grilling demand as that fades away? Does that start to impact this cattle complex? I mean, what's your thoughts overall in this cattle trade, Brian?
Yeah, I think today to start the month, we obviously had a little bit of buying, nothing crazy. Maybe one of the features today, especially in the feeders, was bear spreading. So it seems to me like as we've gotten to these record high levels, when we see the October and the November contract today get within a couple bucks of last week's highs, I think you saw some profit taking on the nearbys and some buying of deferred contracts. And with an inverted market the way it is, if you've got nearbys in the mid 360s, and then you've got May of 26, for example, down around 350, you've got, $15, $16, $17 discounts in some of these deferred contracts where the funds can take profit on the nearbuys, roll their positions out to a deferred contract at a discount and still own it big picture, but at a cheaper price. I think we were seeing a little bit of that today to start the month. Market didn't really give us anything as far as, any major clues today. We did, finish off the highs, but that's not something the market's not done before. But again, the demand is going to be a concern here. I think there are a lot of anecdotal things. You can go on social media and see plenty of posts about people talking about the price of ground beef and, hey, I paid this much for a steak or a set of New York strips at Costco in April of 2024. It was $9.99 a pound. And now I'm paying, $14.99 a pound for the same exact cut of meat. So it's being noticed. I think that's part of, the cogs of the system. We need to do something to demand. Again, really extreme gains for the month of August. We put in lows early in the month and we saw a month of buying for feeder cattle. So we'll see if we get a little tune of maybe the direction to start the month. But the market hasn't given us a sign, that it's made a top to this point yet.
Brian, anything else you would mention or reiterate to folks as we close out the show today?
Yeah, this is probably one of those things for corn and soybeans. Corn's about 30 cents off the lows from last month, and we are very quickly going to be turning to some resistance levels. We had 428 lows last year. We had some 434 lows that we held really through spring into June until we broke down. So I think the focus right now needs to be on bushels that you can't store. Taking this recovery in corn as an opportunity for those bushels specifically. When we think about soybeans, the big picture there, bushels you can't store, we're still closer to the upper end of the range than we are the low end of the range there. And I think producers really need to be taking a hard look at beans for next year, as we get close to $11 and maybe setting some floors under next year's beans, again, with some of those bearish overarching themes that we're talking about over the next couple of months.
Well, I know folks can learn more. They can take a look at your guys' intel, download your mobile app, reach out with questions and more. agmarket.net. With that, Brian Splitt, always good to talk with you, sir. Thanks for joining us again on the show, and we'll talk to you again real soon.
Yeah, thanks, Jesse. Appreciate it.
Make sure to subscribe to the Market Talk YouTube channel. You can watch our latest interviews with top market analysts in the country, find bonus content, and much more. It's easy. Just go to youtube.com/@MarketTalkAg and hit the subscribe button. Or you can search for Market Talk Ag on YouTube.